Welcome back to another portfolio update where I will share with you the changes in my P2P lending portfolio. If you've been investing in P2P loans long enough, you know that it can be a relatively risky investment and you need to keep an eye out for variables that may increase your risk. A periodic re-evaluation of your positions will help you achieve a better balance between risk and return. As you may know, in the P2P lending industry, we distinguish between a crowd-lending platform, where you typically fund business loans from various companies, as well as a P2P lending platform or marketplaces, where you fund personal and short-term loans from multiple lenders. Both categories come with several risk segments, one being the platform itself, the borrower risk, which can be a company or a lender, as well as the country risk, which includes macroeconomic factors that may impact the borrower's ability to repay the loan. You can evaluate the platform risk by assessing their track record and reviewing their portfolio performance, which is relatively easy to do if you regularly read our newsfeed and reviews. However, platform risk is just one segment of the risk equation. You still have the borrower or lender risk, as well as the country risk to consider. Some platforms do a better job of protecting investors from these risk factors than others. This, however, does not mean that you should not question anything. The understanding of a platform's business model is crucial to determine whether there is an inherent conflict of interest. In any scenario, you should be able to evaluate whether the offered guarantees or recovery of defaulted loans is something reasonable or not. You can do so by having some understanding of the financial health of borrowers or lenders, as well as some sort of risk framework to evaluate the country risk. This process is not foolproof, as you are constantly assessing historical data, which doesn't guarantee future outcomes. However, it does give you an idea about the risk that you are taking. In my opinion, it's better to have data to evaluate the risk of my investment than to blindly trust a platform which is incentivized to present favorable news and omit information that could slow down their funding plans. Everyone has a different risk profile, and it's up to you to determine the level of risk that you are comfortable with. You can manage the risk of your portfolio through diversification and exposure, which can be influenced by the data that you have available. Alright, so as we have got this out of the way, let's discuss the changes in my portfolio, which looked like this at the end of July. In the right column, you can see the changes compared to the previous month. On February, I managed to reinvest the return principal and interest. To build a broadly diversified portfolio on this platform is challenging due to the imbalance between loan supply and demand from investors. The biggest safety net on February is the buyback and group guarantees, which are proven security protocols that have protected investors from losses in the past. Investors can therefore take on higher lender and country risk, as there is a reliable guarantee in place. On Estate Guru, there has been no change to my defaulted portfolio. While the platform recently outlined its recovery plans for this year, I will cover that in more detail in next week's performance update. Robocash has just published its consolidated financial statements for the past year, and the financial ratios have deteriorated compared to 2023. In a recent business update, the CFO addressed some of the recent developments, offering a slightly more positive outlook for the first half of 2025. From an investor's perspective, Robocash has long been one of the most reliable platforms. It's easy to use with high liquidity thanks to the strong investor demand. However, despite its solid track record, I've decided to exit my position. The latest financials, combined with the revocation of Robocash's lending license in the Philippines, prompted me to reassess the risk. Although Robocash published a group-level financial report, it's important to note that Una Financial does not offer a group guarantee for its lenders, as confirmed by the CFO.
While the group doesn't guarantee individual entities, it provides oversight, financial support, and maintains a strong audited position.
Additionally, there is little transparency around how the funds raised via its Singapore entity are being used. We also don't have insights into the financials of individual lenders. The group also operates with a high level of leverage, which could pose a serious risk if economic conditions worsen in one of the active markets. Here are our assigned country risk evaluations for the regions where Una Financial is present. While we don't have yet the exact exposure figures, platforms like Twino have shown us how quickly things can deteriorate, particularly in markets like the Philippines, where losing a lending license can pose additional risks. As of the time of recording this video, the lender has still not resolved the issue.
We're actively seeking to clarify and resolve the issues affecting its registration and license to operate as a financing company.
Ultimately, hoping everything works out is not a strategy I'm comfortable with, especially when there are alternative lenders with stronger financials and lower risk. That said, as of this recording, Robocash continues to operate normally with no reported issues. Last month, I reinvested the principal and interest from Esketit and added new funds to Fintown. I used the opportunity to invest in the Carlin rental project, which I had visited in person last year. Currently, my main exposure on the platform is to rental projects in Carlin and Życeny, both of which have delivered solid results so far. Fintown also published its Q2 performance report recently, offering a closer look at the monthly earnings of these properties. Interestingly, both projects generated slightly less income in Q2 than initially forecasted. While revenues continue to grow month over month, it's clear that pricing strategies and seasonal trends are influencing the more optimistic projections. Moving on to CrowdPeer, where I increased my stake in a recently published P-rated project. I've also increased my exposure to Lande, which performs as expected. I haven't made any changes to my position on Indemo. On Income Marketplace, I simply reinvested the repayments I received. My main exposure remains with iBankar, which continues to lower its offered interest rates. This trend raises the question of whether I will stay invested if the returns keep declining. As of this recording, iBankar has not yet published its financials for 2024. If and when they do, you will find a detailed breakdown on P2P Empire. The exit from Robocash has freed up some capital, which I can now redeploy elsewhere. Several lenders have started publishing their 2024 financials, providing a good window to reassess the risk and return ratio from a lender's perspective. I've picked up 2 lenders with solid financial ratios and a good track record. Those are Stick Credit on Afranga and Credit Prime on Nectaro. The lenders reported the following ratios with exposures in Bulgaria and Romania. Both lenders show good equity levels in relation to their liabilities. Additionally, both have been operating for several years in their respective markets, growing their profit year over year. I'm currently creating a database with the main financial ratios for many lenders in the industry, which will soon be available on P2P Empire. This will help you to reassess the risks to various lenders, mainly if you are investing directly into loan originators. At the end of July, the portfolio dropped to €100,127, representing a decrease of 13.5% compared to June. This portfolio generated €1,133 in passive income last month, representing a 22.6% increase from the previous month. Most of my investments are on Peerberry and Fintown, followed by Esketit and Lande. When it comes to the loan status, 6.8% of my portfolio is not performing, while the rest continues to generate interest. The portfolio is diversified across various countries, with larger shares in South Africa and the Czech Republic. The portion of short-term loans increased, while the share of commercial loans decreased last month. Around 25% of the portfolio is secured with a mortgage or other form of collateral, whereas 75% are unsecured loans backed by a group or buyback guarantee. My weighted average interest rate decreased to 10.95%. The average investment per loan is €300 and the portfolio is spread across 333 loans in 16 countries. For more insights into the internal return rate for each platform, you can review our portfolio page on P2P Empire or access the semi-raw portfolio data on buymeacoffee.com, which is available to our members. Before we wrap up, I want to stress that this is no investment advice. Everyone is in a different financial situation and your risk profile might be different from mine. Investments in P2P loans are risky and you alone are responsible for your investment decisions. That's it for this quick update on how my portfolio is developing. If you found this video valuable, hit the like button and subscribe for further updates. Thanks for watching and I'll catch you in the next one.